the government is always trying to take that money every single year. They'll never stop. So this is the appropriate way, in my experience, to be able to view what tax looks like. So I like to think of tax in a couple of layers. The initial layer that as everybody is typically familiar with is like some form of like deductions. And the deductions you guys have probably already heard about, but just to cover off on quickly, are going to be like your simple ones are like, can I maximize like my home office deduction? Can I keep one car as like my personal daily driver, but keep all of my other cars as business expenses? And then also, this last one is like gifting to kids and hiring your kids. You can gift up to the yearly gift tax thresholds, and that shifts the money to the kids. So that way the kids are always going to be at a lower tax bracket than you are. And then similarly, you can hire your kids at a reasonable wage. And that can even be like they're a model on your website or something, right? It can be a lot of different ways that kids are able to, quote unquote, like work and support of a company, and also able to get some type of reasonable wage there. There's also things to look at that are like the Augusta rule, where you're able to then essentially be able to lease one of your properties essentially to your own company for up to 2 weeks. That was actually from like the Augusta Nationals golf course. Like all those guys were able to get together and pass this law. And you're able to collect that money and not have to pay tax on it as well. There's other forms of deductions that are notable, right? Where we look at retirement accounts. And this is a retirement accounts are a great way to like avoid taxes. And this is going to be things like a solo 401k or a self-directed IRA. And these are both great because you can take the money, you push it into the retirement account. Once it's inside the retirement account, you can purchase real estate with it if that's what you want to do. The money grows tax-free inside of the retirement account. And then you're able to pay tax on that money depending upon how you set it up on much later when you retire, when your income is much lower. And ostensibly, you're going to be paying less in tax at that point. So depending upon your belief structure, what future tax is going to be like, it depends upon exactly some of the details in here. So these are a great way to avoid tax with money that you're making right now. The problem with it is that this locks up your money until retirement. The good part about it is that these types of contributions that are types of deductions against your tax don't impact your ability to get financing. So when you start to do things like, well, I'm going to just jam a bunch of expenses inside of my business to be able to lower my tax burden, what the problem that you can run into is that you're no longer able to qualify for financing, because the assumption that the financing institutions make is that all of your business expenses are legitimate business expenses that you're not able to effectively reduce. So they'll say, well, we don't believe that you're actually able to get access to more capital than what you're claiming there to be able to qualify for financing. But if it's contributions, voluntary contributions you're making to a retirement account, that won't impact your financing. The theory there is, well, you'll just stop contributing to your retirement accounts, and therefore you'd have extra cash, and so then you can qualify for your financing. So this is something important to keep in mind with whatever types of deductions you're taking to work with your CPA. And that will help you look at the deductions you're taking, the financing rules that are going to apply to that, as well as your investment objectives. So this is why it's important to have really quality team members that are looking at a holistic picture, not just one facet of what it is that you're doing. After you maximize your deductions, then your next level up after that is going to be things that we would call like tax shelters. So tax shelters, it would include, these types of retirement accounts that we just talked about. Tax shelters are really anything that's an entity that helps protect us from tax. Other things that I really like and that are standard for us are going to be things like a private foundation. Private foundations, I think, are something that we should all look into very, very seriously, because in private foundations, I can protect 30% of my income from tax. So if I made $200,000 that year, I can make up to $60,000 in contributions to my private foundation, which will reduce my taxable liability. Now, that $60,000 in contributions doesn't have to be money that I took in that year. It can be art. It could be automobiles that I've already fully depreciated. It can really be anything that has a legitimate value that we can associate with it to contribute to the private foundation, and then be able to take that additional write-off. What's great about private foundations, though, is let's say I went ahead and I took out of my 200K, I went ahead and said, I'm just going to go ahead and contribute $60,000 to my private foundation. Then what that private foundation is able to do is able to invest that money in any type of asset or business that it wants to. And the money that it invests, and as this grows, also grows tax-free, just like it was inside of a retirement account. But what's different than this versus a retirement account is when you withdraw money from retirement accounts, you're typically having to pay penalties to withdraw that money out of the retirement account and get it back if you needed it for some purpose. With a private foundation, you're a director, so you can actually take a reasonable wage, which is an undefined term. It's very, very broad of how much a reasonable wage can be. And what that allows you to do is to take the money back out of the private foundation, pull it back into your personal name, and then to be able to use it without penalty. So typically what we're looking at is some type of combination between deductions, retirement accounts, if those are appropriate for you, or private foundations to grow. Most of our clients that are interested in becoming financially free in the short term prefer private foundations because they don't want money locked up for retirement. And what they'll do is then grow this investment income inside of the private foundation. And then this is where their passive income comes out to them. It's going to come out to them like a director's wage from the private foundation. And that's what they'll use for their cash flow for financial freedom. So this will get, these strategies alone should take your tax bracket from like 30%, down to like 12-ish% in most cases, right? When we look at like, what's your effective tax rate? So on somebody who's making $200,000 a year, that's taking you down from $60K a year in tax to $24,000 a year in tax, whether you're W-2, 1099, it doesn't matter. Private foundations are available for any income type. The last thing that we want to look at is to reduce your taxes is going to be the types of investments that you're making, because the types of investments you're making are going to have tax advantages to it. So if you're a real estate professional, or you qualify as for real estate professional for IRS purposes, you don't have to be licensed to qualify as a real estate professional. It has a claim to do with number of hours that you spend working in real estate. This will allow you to take, passive losses and apply it against active gains. So that's active gains are going to be like your W-2 or 1099 income. And so people that qualify for rep status, typically what they're doing is they're investing in bonus depreciation type deals. Either they're going to get in those on their own because they can buy those on their own, or they're doing it as some type of syndication investment. My favorite right now is actually in self-storage units that I have, 180 or 200% bonus depreciation. Each year, the bonus depreciation decreases unless Congress passes another law that they're talking about right now to re-up it to 200% to support the real estate market, but that's not into effect yet. People that can't qualify for rep status that are W-2, that are looking for investment type related tax benefits. For our W-2 people that are out there, or non-rep people that are out there, my favorite thing to look at right now is going to be different types of oil and gas investments, because these types of investments have a different kind of depreciation than real estate. These are machinery-based depreciation, and machinery-based depreciation will actually apply against W-2 income. Typically, it's only like 90 to 95%, depending upon how the deal is structured, sometimes a little lower to how they do it. But remember, if I make a $100K investment, right, and I can get, $95,000 back in depreciation or a tax offset from this oil and gas investment, and I'm at a 30% income bracket, Well, that means I just saved a little over 30K in tax in year one from making this $100,000 investment. So this $100,000 investment actually paid me in year one 30K in tax savings in my pocket this year. Plus, it's going to have whatever is going to be the subsequent dollars that it's going to pay me out over time. There's no other investment that pays you back such big amounts of money than looking at what the tax avoidance is going to be if you can't get there from the other structures that you have put in place here.